In 2000, General Electric was the most valuable company on earth. Not Apple, not Microsoft, not Amazon, General Electric. Its market value passed for $100 billion, its CEO was treated like a head of state, and its management system was taught in business schools across the world. J wasn't just successful, it was considered untouchable. And yet, less than 20 years later, General Electric would be removed from the Dow Jones Industrial Average after being part of it for over a century. No scandal, no fraud, no single catastrophic event. Just a slow, quiet collapse. This is the story of a company that didn't lose control, it lost perspective. This is General Electric, and this is how efficiency became a weapon pointed inward. General Electric began as a real industrial giant, building the infrastructure that powered modern civilization. Power turbines that electrify entire cities. Medical imaging equipment that revolutionized healthcare. Jet engines that made global aviation possible. Rail systems that moved economies. These weren't trends or fads, they were the foundation of industrial society. By the 1980s and 90s, GE products powered cities, hospitals, airlines, and entire national economies. The company's reach was almost incomprehensible. If you turned on a light, flew on a plane, or had an MRI, there was a good chance GE technology was involved. But GE's real pride wasn't its machines, it was its management system. Under CEO Jack Welch, who took control in 1981, GE became obsessed with one idea: efficiency. Every division was measured relentlessly, every manager was ranked against their peers. Every process was optimized and re-optimized. Welch implemented a brutal system: if a business unit wasn't number one or number two in its market, it was fixed or sold. No exceptions, no excuses. This approach worked spectacularly. Quarter after quarter, year after year, GE delivered smooth, predictable growth that seemed almost supernatural in its consistency. Wall Street loved it, business schools worshipped it. MBA students studied GE's playbook as if it were scripture. The company became less of a business and more of a perfectly engineered system. And systems, once perfected, don't question themselves. Over time, something subtle but profound happened inside General Electric. Success stopped being about building great products, it became about hitting targets, short-term earnings targets, quarterly expectation targets, constant growth targets. The focus shifted from long-term innovation to short-term performance, from engineering excellence to financial engineering. And at the center of this transformation was GE Capital, the company's financial services arm, which grew larger and more profitable than its industrial core. J wasn't just making turbines and engines anymore, it was making money from money. Lending, leasing, insurance, credit cards, GE Capital did it all, and it did it with the same ruthless efficiency that had built jet engines. On paper, this looked brilliant. Financial businesses delivered faster returns than manufacturing. They smoothed out earnings volatility. They kept investors happy with predictable growth. GE could have a bad quarter in jet engines, but a great quarter in financial services, and the numbers would still look perfect. But financial services also introduced something the industrial side never had: invisible risk, massive complexity, and fundamental opacity. The company became harder and harder to understand, even from the inside. Executives who had spent careers building physical products now oversaw financial instruments they barely comprehended. But they trusted the numbers because the numbers had never failed them before. The numbers showed growth, the numbers showed profit, the numbers showed success, but the numbers were no longer telling the whole story, they were telling the most convenient one. GE's internal culture, once built on engineering innovation, had transformed into something else entirely: a culture that rewarded certainty and punished doubt. Managers who hit their targets advanced up the ladder. Managers who raised concerns or missed projections stalled or were pushed out. This wasn't a conspiracy or a deliberate cover-up, it was simply how the system evolved. Problems weren't hidden outright, but they were softened, delayed, reframed as opportunities, or buried in positive language. Not out of malice, but out of survival. When an organization worships efficiency above all else, uncertainty becomes dangerous, questions become career risks. Doubt becomes disloyalty. The warnings were there. Risk managers warned about GE Capital's exposure to subprime mortgages and complex financial instruments. Engineers warned about chronic underinvestment in core industrial products while competitors innovated. Industry analysts questioned the sustainability of the business model and the opacity of the financial division. But those warnings didn't fit the narrative of smooth, predictable growth. They introduced complexity into a story that was supposed to be simple. They suggested the machine might not be perfect. So leadership kept doing what had always worked: to optimize, cut costs, streamline operations, sell underperforming assets, buy back shares to boost stock price. The company looked healthy on every metric Wall Street cared about. But beneath the surface, beneath the quarterly earnings and the stock buybacks and the efficiency gains, the foundation was thinning. Jay wasn't adapting to a changing future, it was desperately protecting a perfect past. The 2008 financial crisis didn't destroy General Electric, it exposed it. When credit markets froze and the global financial system seized up, GE Capital went from crown jewel to existential threat almost overnight. The division that had smoothed earnings and driven growth for decades suddenly needed tens of billions in emergency funding just to stay liquid. Jay had to seek emergency support from Warren Buffett and the federal government, a humiliating reversal for a company that had been considered one of the most stable in the world. Trust evaporated instantly. Investors realized they didn't fully understand the company they owned. Regulators realized they'd been monitoring a financial institution disguised as an industrial company. Employees realized the invincibility was an illusion. Leadership changed. Jeff Immelt, who had taken over from Welch in 2001, tried to steer the company back to its industrial roots, but the damage was done. Strategies shifted constantly as the company tried to find its identity. Massive assets were sold off in NBC Universal, the appliance division, eventually most of GE Capital itself. The company that had grown through acquisition for decades was now shrinking through divestiture. But the damage wasn't just financial, it was psychological and strategic. GE's identity had fractured. It was no longer the industrial titan that built civilization's infrastructure. It was no longer the financial powerhouse that Wall Street admired. It was just a collection of shrinking parts, each valuable on its own, but no longer adding up to something greater. In June 2018, after 110 years as a component of the Dow Jones Industrial Average, one of the original 12 companies when the index was created, General Electric was removed. Not because it collapsed suddenly in a dramatic implosion, but because it had slowly, quietly stopped mattering. General Electric didn't fail because it was lazy, corrupt, or incompetent. It failed because it optimized too perfectly for the wrong era. Efficiency replaced curiosity, the drive to make things better replaced the drive to understand if better still meant the same thing. Metrics replaced judgment, numbers became reality instead of representations of reality. Predictability replaced resilience, the system was optimized for stability in one set of conditions, making it brittle when conditions changed. Short-term results replaced long-term strategy, quarterly performance became the only performance that mattered. The company became perfect at playing yesterday's game, with yesterday's rules, for yesterday's prizes. This is what silent collapses look like. They don't announce themselves with scandals or catastrophes. They happen while everything still looks stable, while the numbers still look good, while leadership still projects confidence. The collapse begins years before the market notices, hidden beneath layers of optimization and efficiency. By the time the metrics finally reflect the reality, by the time the stock price actually falls, by the time the company is removed from the index, the collapse has already happened. The outcome was locked in long ago. The rest is just documentation. General Electric was one of the most admired companies in the history of American capitalism. It built the infrastructure of modern civilization. It pioneered management techniques still taught today. And it collapsed not with a bang, but with a whisper. Not because it failed to execute, but because it executed perfectly on the wrong strategy. This was General Electric. And this is how giants fall without making a sound. Thank you for watching.